Good evening, everyone, and sorry for having to wait for so long. Thank you for waiting with us. On behalf of Axis Bank, I welcome you all to the 22nd edition of Treasury Market Talks. We at Axis Bank have been instrumental in serving a wide spectrum of customers through our innovative financial solutions and products, and we want to cover large and mid corporates, SMEs, multinationals, agriculture, and retail businesses. As a bank, we've used our technology to provide uninterrupted, best-in-class service, benefiting our wide customer base. And as part of our services, we also want to equip our clients with high-quality input around emerging issues. Uh, the, the Treasury Market Talks, the TMT, this series is an event with respected thought leaders across the world in the macroeconomics and geopolitics space. And we've had Joseph Stiglitz, Michael Pettins, Baroness Ashton, all of whom have spoken on the areas of expertise and have good participation and responses. Today, we'd like to set up a discussion on industrial policy, which is basically where governments intervene to change incentives in markets and economic activity, taxes, subsidies, and other policies. And that's where things appear to be going as of now. Today, we have Brad Spencer, who's senior fellow at the Council on Foreign Relations and formerly of the U.S. Treasury, where his expertise was on currency policy and financial sanctions. Speaking with Mr. Setzer's Neelkanth Mishra, Chief Economist at Axis Bank, and the Research and Program Director at Access Capital. Some housekeeping announcement. Part the invitation only. Axis Bank reserves the right to block access. So the invitation has not been sent. Unauthorized dissemination of the contents of this webinar is also prohibited. Prior explicit permission of Axis Bank is imperative. As a reminder, all participants during panel, participants who wish to ask a question may post on the question box on your screens. Please may involve the presence of the media. I now hand over the forum to Neelkanth. Thank you.
Yeah, thank you, Tanay. Thank you, everyone, for staying on. I realize we are significantly delayed. I mean, there are some technical issues with getting Brad on the line. I thought we should start off anyway. There is, as you know, there is a lot happening on the industrial policy side. I'll come to that, and we expect Brad to join in a few minutes. So then we will get cracking with that discussion. What I thought would also be useful, given that the budget is on Tuesday, just a couple of days away. There is a lot of expectation in the Indian markets with regard to the budget, and given that the president, in her opening speech to the joint session of Parliament for the new Lok Sabha, mentioned that this could be a historic budget. There are, I think, lofty expectations from what could come about. So there are two parts to the budget, as you know. There is the budget speech, and then there is the fiscal math. Both need not be the same. Of course, the budget speech does refer to the fiscal math, but budget speech can also be used to announce new policy pronouncements. On the fiscal arithmetic per se, I think the government has quite a bit of fiscal room, and they're just to figure out an unexpected bounty of about 1.5 lakh crores, 1.5 trillion rupees, which to a large extent is coming from the increase in the RBI dividend, which was 1.26 trillion rupees higher, 1.26 lakh crores higher than what had been budgeted in the vote on account. There is likelihood of higher dividends from public sector undertakings, whereas the government seems to have given up on the divestment. The priority seems to be to run them well and also then use them as a source of dividends and revenues. And that, of course, the companies themselves are doing much better. The dividends last year were much better than expected. And it is reasonable to expect that that level can persist. So that's another about 20,000 crores. In addition, the personal income tax to GDP has been going up very sharply. The increase used to be about 5 basis points a year. As you know, any economy, as it prospers, the income tax payouts start to improve. The state has better capacity. and people also, as they cross a certain income threshold, are more likely to pay taxes. So that has been happening. What we have seen quite encouragingly is that tax to GDP ratio on the personal income tax side has now started to accelerate. So there has been 20 plus basis points of improvement in the last couple of years. And if you look at the last 12 months, the rolling 12 months, there is again a significant improvement. So that itself can add up to 55,000 crores, these improvements, even on conservative numbers. But at the same time, there's been a bit of a slowdown on corporate taxes and a bit of a slowdown on the GST collections, and of course on the excise duty side. So therefore, it is reasonable to expect that the total fiscal number that the government needs to adjust for is about 1.5 lakh crores. Now, how will the government choose to spend it? I think the philosophy used, and that's actually the most important thing here, it should be that if you have a one-off benefit, that is, if you are having to deal with what may or may not sustain over the next several years, it is reasonable to expect that the expenditure also should be in the nature of a one-off. So, contrary to what some at least have been hoping for, that the government will start a new income transfer scheme, which I think is very unlikely, given that it would be a continuing expenditure, and the government, I think, will recognize the fact that some of these gains are one-off in nature. And therefore, our expectation is that about 800 billion rupees would be used to bring down the fiscal deficit ratio. So the government, as you know, had budgeted for a 5.1% of GDP target for FY in the vote on account for FY25. We think that they will bring it down to 4.9. The basic underlying principle, in our view, would be that if the government thought that a 70 basis points consolidation was sufficient in January, given that the economy has actually done better than expected, it may think that that level of consolidation is still worth doing, and therefore the 20 basis points of additional consolidation that happened in FY24, the government had penciled in 5.8% in the revised estimate. It turned out to be 5.6, and therefore I won't be surprised if the FY25 deficit is brought down to 4.9. So there is that, it's actually 5.14 to 4.86, which is why the number comes up to be about 80,000 crores. In addition, the government again can use some of the extra surplus to give more loans to state governments for the interest-free loans that it gives for capex, and there could be some additional allocations on the expenditures like Pradhan Mantri Awas Yojana. So the principle being that if it is a one-off gain, then it should be used in that form, and if it is a continuing gain, like say the growth in income tax to GDP, it should be used like that. So I can see that Brad has joined us. So welcome, Brad. We'll start off with the trade, the Industrial Policy Redux session. I'll quickly run through a quick introduction, and then we can get going. So the ratio of global trade to global GDP has been stagnant over the past decade and a half. We have seen multilateral trade agencies like the WTO losing potency. In fact, with the US itself sidestepping many of the regulations and the dispute resolution taking ever longer, people are starting to get restless. I was at a dinner in Singapore in December 22, just after the Inflation Reduction Act was passed. I was on the same table where there was a Korean and a European trade negotiator, and both were egging each other on that, why don't you file a complaint against the US? We will support you. So clearly there is, I think, trouble in the global trade system. We are seeing a competition between economic and political systems. On the one hand, we have China, where the political system allows for systematic financial repression. It enables a seemingly unending ability to bear balance sheet losses. For example, between March 20 and March 24, Chinese banks have lent an additional $1.9 trillion to industry. This is lending, which was earlier going to real estate, is now going to industry. If this persists at this level of growth, in the next 4 or 5 years, they could lend $2.5 to $3 trillion additional to industry. This is gargantuan in comparison to any other country, including the US, in terms of the scale of intervention. Despite all the China plus one stories we've all heard, China's share of global manufacturing continues to rise. It reported a record high goods trade surplus last month. Political systems are now reacting. So while China's system is uniquely designed to use balance sheet strength and have amazing tolerance for bad loans and overcapacity, other systems are now responding. The first salvo, if you recall, was the Trump tariffs in 2018. Since then, bipartisan consensus is becoming visible in the US. Now the Europeans, which are much better at rule following and have a notoriously slow pace of decision making, have also begun to respond. In the next few years, we are likely to see an intensification of such measures. Industrial policy, which, as Tanay also explained, stands for governments intervening in the normal functioning of markets through various tools. It could be fiscal, it could be monetary, it could be currency manipulation, or tariff and non-tariff barriers. So it tends to start with a small yard, high fence approach, which the US claims to be following. But history tells us that the yard keeps getting bigger over time. So to help us think through these complex topics, we have an expert here, Brad Setzer. We couldn't ask for a better person. He is a senior fellow at the Council on Foreign Relations. His expertise includes global trade and capital flows. Those of us who follow him on Twitter are very fond of, are very big fans of his work on tracking flows in and out of China. He has worked as a senior advisor to the US Trade Representative from 2021 to 2022. He's worked on several trade disputes, so he's uniquely qualified to answer in great nuance and detail some of the questions. So welcome, Brad. We will start with some background on industrial policy itself. We seem to think that free markets and free capital flows are the norm. We would like it to be that way. But historically, states have indulged in active industrial policy, and that is indeed the norm. So if you could just help us understand, help the audience understand, what are the mix of industrial policy tools that can be used, and how is that changing? I mean, between tariffs, non-tariff barriers, standards bodies, fiscal intervention, etc.
Sure. Just let me make sure my audio is at
We
the
can
right
hear you.
level. You can hear me?
Yeah.
Okay, good. I apologize for the unexpected difficulties. Look, I don't actually think there is a single set of industrial policy tools that are used uniformly across all different jurisdictions. Industrial policies are policies directed at supporting individual sectors, and they tend to be developed inside the context of a given political and economic system. So in, say, China, many of the key industrial policies are carried out effectively through directed credit support. The central government sets out a target, it identifies a particular sector as a priority sector, and then that sector benefits from better access to the state banks. And the state banks lend at lower rates, and they lend to a small or medium-sized enterprise. It benefits from directed investment from government guidance funds, and it benefits from subsidized equity investments as different provinces compete to support either a local state enterprise or a private company as it tries to expand and meet these industrial policy targets. There are sometimes direct subsidies as well. Don't discount those direct subsidies. And there's a very, very strong system of informal local preference. So the famous example is with the Chinese electric vehicle industry. In order to qualify for the consumption subsidies, you had to make it onto a list. And in order to get onto that list, well, it turned out that no imported car ever made it onto the list. You had to be a car that was made in China. Moreover, it had to be a car made in China with a battery that was made in China. And although they liberalized some of the policies at the very end, it actually initially had to be a car made in China with a Chinese-made battery made by a Chinese company. So Korean companies making batteries in China weren't eligible. So that is probably the most strong form of local preference. So you have policies that promote demand, say for new energy vehicles. You have policies that subsidize the creation of battery supply, direct support for the key firms, direct support for firms going out and collecting the minerals and refining them to make them into batteries. And then finally, easy access to credit and cheap equity for the myriad of firms that were set up to try to create electric vehicles. Same thing in, say, semiconductors. I think if you're understanding semiconductors in China, you need to understand that is the most of the support is coming through easy access to credit, subsidized access to capital. In the US, by contrast, we tend to do our industrial policy or our new industrial strategies heavily through the tax code. It's special tax preferences, a very, very favorable depreciation for new investments in semiconductors, tax credits for investment in wind and solar, together with a few modest direct subsidies, notably for semiconductors. We also, in the Inflation Reduction, North American preference for cars and North American and free trade agreement preference for batteries, which are, as you alluded to, debatable in their WTO consistency. The Europeans have focused on some direct subsidies for projects of a common European interest and some non-discriminatory support for the adoption of electric vehicle consumption. I just am focusing on that sector as an example, but I think the key point is it's a mix of easier access to credit, particularly in countries which have state-directed systems of credit, easier access to capital, sometimes government equity participation, sometimes government direction of equity into a preferred sector, favorable tax treatment, and then sometimes protection and preference to assure the creation of a market.
Yeah, thank you. No, that was very clear. In fact, that leads me to a question that, on the one hand, you have a whole bunch of policy support being given. I mean, also companies that are not allowed to go bankrupt. There seems to be an unending capacity to bear losses. And on the other, you have these rule-based systems, particularly in Europe. So do you think that as these policies evolve, we will, the systems that are fighting this battle on very different rules would have to change the rules themselves? So would the US and Europe have to start doing things that they can't contemplate right now in order to actually compete with the Chinese, where the rules are very different?
Look, I think that highlights a key difference between the US and Europe and a key tension between the US and Europe, to be honest. The US more or less concluded during the first Trump administration, and I think it's continued under the Biden administration, that the US was not going to follow the strict letter of the WTO rules when it devises its industrial strategies. The Trump administration focused much more on tariffs, but it didn't go through the standard WTO process. It didn't launch a countervailing subsidies case against a specific subsidy that was present in China. It launched, a Section 301 case against a broad array of policies, in this case, tech transfer and the failure to protect intellectual property rights that were perceived to be burdening U.S. commerce. That created in the U.S. law the legal basis for tariffs, and then it responded to China's tariffs with more tariffs. What word doesn't enter into that discussion? The WTO. None of this went through any approved WTO process. The Inflation Reduction Act uses discriminatory subsidies. Buy North America for EVs is of debatable WTO consistency. It discriminates amongst WTO members. It favors in a subsidy EVs made in North America over EVs not made in North America, whereas the WTO principle would be all EVs made by WTO members should get the same consumer subsidy. So the U.S. is broadly operating outside of the WTO, at least vis-a-vis its trade with China. Not vis-a-vis everyone, but definitely vis-a-vis China. So in that sense, both the US and China are outside the rules. That annoys the Europeans to no end. The Europeans, by contrast, have tried to stay within the rules. A countervailing duty case, even against EVs, requires identification of the subsidy, identification of the harm, tariffs that are proportionate to the subsidy, and then duties that reflect that combination. There is, I think, going to be pressure on Europe to go a little bit beyond the policy mix that it is using now, in the sense that I think over time, the Europeans are going to need to introduce some buy European provisions into their industrial policy toolkit. Let me conclude this segment by making a general note. The WTO does not prohibit subsidies, domestic production subsidies. Those are permitted. They are countervailable. You can try to offset the distortions they create, but there is no WTO prohibition against a subsidy. So the very large subsidies that the US is providing its semiconductor manufacturers are 100% WTO consistent, but other countries potentially could bring a case around the impact they have on their trade. Many of China's subsidies, to be fair, are production subsidies that are WTO consistent but countervailable, which is the approach the Europeans are taking. There are also more WTO prohibited measures. Typically, those are subsidies that explicitly aim to subsidize exports, or subsidies that explicitly aim to substitute away from imports, or linking the subsidy for a consumption as opposed to production to your own production. I think over time, we've already seen the US, in some sense, try tariffs that are outside the WTO system, and then conclude that those tariffs on their own weren't achieving US goals. So the US has moved towards more subsidies. Now, WTO consistent mostly, some not. And so I think the tendency is to escalate measures and to use new tools, again, some in the WTO, some outside the WTO, to try to match China, because China's, depending on the sector, now has a head start, plus it has, as you alluded to, the full backing of the state.
Thank you. That's very clear. And the big picture that you're painting for us is that so the reason why industrial policy, most free market theorists were used to work against, was that what does the government or a few people know about which sector to promote and let the free markets work? And given that here you are competing against an economy or a political system where someone has taken those decisions and you're unable to fight it with the existing rules, so you're willing to violate some of those rules yourself, and in order to be able to fight better. And so that brings me to the next question. How much of that, how much of a debate are we going to have? We're already having it, but how long can this sustain, on whether Chinese subsidies can be used as an advantage, right? Because the concern some are flagging is that the biggest concern, biggest worry for the world today is the green transition. So if the Chinese are willing to give you cheap solar panels, cheap batteries, and cheap EVs, why do you have a problem?
Look, that is a very active debate, I assume, in all countries around the world. You can reach different answers for different sectors, to be honest. You can say with say for solar cells and solar panels, that the advantages of using a well-supplied, oversupplied even, Chinese supply chain are larger than the advantages of building up your own industry. So no matter how we got here, no matter what unfairness ensued along the way, taking advantage of the capability, the cheap, large, available supply is always an option. I mean, to be fair, and I think it's an option that for many countries, it's the preferred option. But there are sectors where different considerations come into play. Most obviously in the electric vehicle sector. And I think you can view other sectors as being somewhere in the spectrum between these two poles. And I think you can view this as a debate where different countries come up with different answers. But in the electric vehicle sector, I think there are three reasons why the advantages of cheap Chinese supply are not considered to be as significant as the advantages of trying to build up your own industry. The first argument is that, look, China built up its advantage now. It built up the success of companies like BYD and CATL in the battery space with its own industrial policy, so that your policies are needed to let your firms catch up to China. And it would be a strange outcome to say, because we don't believe in industrial policy, we don't believe we can identify a given sector as a potential success, we're going to hand this industry over to a country that clearly believes in industrial policy, that is engaged in industrial policy, and is engaged in a fair amount of overt discrimination. As I mentioned, no imported car ever qualified for China's EV subsidies. The second argument is that, broadly speaking, the auto industry right now, the conventional engined auto industry, is a very important source of employment in many regions in the US and Europe and Japan and India, Thailand. And many countries have come to the conclusion that as a matter of economics, they don't want the transition to electric vehicles to be a transition to Chinese-made electric vehicles with Chinese-made batteries. There are not any production jobs associated with that. And there's a perception that the shock to employment and to output would be big, and that it wouldn't easily be made up, that the standard models of adjustment where one sector fades and other sectors sort of automatically rise, it's a little hard to see how that plays out smoothly for a sector like autos, which is still 5 to 6% of European GDP, 3 to 4% of US GDP, and a non-trivial source of employment and jobs. The third argument is one which is basically some mix of crass domestic politics, which we obviously, we in the US are in an election cycle, so it's worth noting, and national security. The crass domestic politics are simple. The state that's most likely to decide the outcome of this election is Michigan, and the state that makes the most cars, conventional cars, is Michigan. So there is no political coalition in the United States that would replace Michigan-made internal combustion engine cars with Chinese-made electric vehicles. We would prefer, collectively, because of the way the electoral system works, to not import the Chinese cars and keep things as they were. Forget the climate, so to speak. On a more broad general basis, there's concerns about dependency, about relying on some other countries' technologies and relying on technologies where access to that technology in negative contingencies could be cut off. And I think that maybe plays a less role in the electric vehicle debate, but that plays a very, very significant role in the debate around semiconductors. So to get to your question of how do you pick sectors? In some sectors, you pick sectors because you think these sectors, in the US's case and in other countries' cases, are going to be key parts of a new economy. You believe you know the direction. You know you want to move towards lower carbon intensity, and you want to make sure your economy develops capabilities in those sectors, or because you believe you have a vulnerability, that these sectors are strategic, and that without the capability to produce in your country, you could be at a disadvantage in an escalatory, conflictual scenario.
No, absolutely. And just to add that some more context and flavor to that, it's like, electric vehicles. I think what China is now working on are the eVTOLs, like the levitating, the flying cars. And if China has 60% of electric vehicle production, they have 90% of eVTOL production, and there the battery density is much higher. And because they are dominant on EVs, they are much better capable, or much more capable of getting down that path. Now, or like, apparently Mr. Musk is going to launch a full self-driving on the 8th of August in China. And given that the driver cost is a very large part of driving cost or mobility cost, doing away with that, in fact, the Chinese take the lead on that, then the world gets even further left behind. So I hear you, and I think that those are very important arguments. So that's a good segue, given that you mentioned the political side. So with Mr. Trump now all-out favorite, with possibly even the Congress and the Senate going with him, or the Republicans at least, I know there will be factions. What are the things that we can expect, given that there are inconsistencies in all the pronouncements he has made, right? So he says no immigration, but that's inflationary. He wants low, weak dollar. He wants to have a higher fiscal deficit. I mean, all of these are, I think, somewhat inconsistent. So help us understand. I mean, I know he's very unpredictable. We're all going to be waiting for 6:30 a.m. when he wakes up and tweets about something. But how do we sort of think about U.S. policy with Mr. Trump in the saddle?
Well, I guess you have an intrinsic advantage over me, because 6:30 is not U.S. time, is not so early in India. It's pretty early here. He is I think we would all be better off if the White House under Trump had a no tweeting before 9 a.m. kind of policy. But look, look, I'm going to have to move to get a better to connect my phone here. Just a second.
Sure.
Okay, this should be better over time. The inconsistencies that you have highlighted, that others have highlighted in President Trump's policy program, are real. They're well known, and it becomes a question of how President Trump himself resolves those tensions. In the first term, he basically tacitly accepted dollar strength. He complained about it on occasion, but he didn't do anything to bring the dollar down. And to a degree, that undercut his desire to induce a renaissance in domestic U.S. manufacturing. So the question for his second term, if there is one, is will he take more aggressive actions to prioritize certain of his goals? For the dollar, would he, and it seems unlikely, scale back on his tax cuts or do more spending cuts to make his overall policy approach less fiscally expansionary? Would he put or select a Fed chairman? He will have a chance to do so early in 2026, I think, that would adopt a lower interest rate, more inflationary policy that would bring down U.S. real interest rates and thereby try to weaken the dollar. Would he, this is something that he has mentioned in the past vis-a-vis China, would he adjust tariffs so that if another country's currency depreciated, he would add to the tariff to try to offset that advantage. We don't really know, but it is the case that his policy program is inconsistent. It tariffs the most on the international side. You put big tariffs on China, the most likely outcome is that China depreciates its currency. And when China depreciates its currency, other currencies in Asia depreciate. So that's an inconsistency if you want a weaker dollar. His expansionary fiscal policy is also inconsistent typically with a weaker dollar if you want to keep inflation stable. Putting tariffs on, unless you have the view, I think with tariffs, the tariffs have a contractionary impact because they're a form of a tax increase. But if you're going to use the revenue to cut other taxes, then it becomes both a supply shock and a demand without a demand offset, and it becomes inflationary. So Trump will have to juggle different goals. Now, Trump's been very comfortable doing that, and he's been comfortable making tactical mid-course corrections. The initial tariffs on China weren't comprehensive. Apple was excluded. At the same time, the overall thrust of Trump's policy has been to expand the scope of the tariffs. So it is a little difficult to imagine that isn't even with the tensions and contradictions, that Trump doesn't expand significantly the scope of the tariffs in some way. So with respect to China, the current tariff regime has an average tariff of 18%. 15% of that came from Trump's tariffs. And that's 25% on a lot, 7.5% on 100 billion, and then maybe 150 billion that has no tariff. If he does either of the two policies that he has put forward, if he eliminates the WTO treatment, or the preferred trading nations thing, that brings average tariffs up to 45%. And he has suggested that could go up to 60%. Would he put in place some exclusions, or would this apply to everyone, including Apple? An open question. If it hits everyone, including Apple, that's very relevant for India, given that India is Apple's +1. And I'm not sure there's enough production in India to meet U.S. demand if there's really a prohibitive 60% tariff on imports from China. But there's also a deeper question, which is if you do 60% on China, the incentives to do assembly outside of China using Chinese parts and getting zero tariffs are incredibly strong. And so do you extend those tariffs in some way? One idea is to do this 10% across the board tariff. If you do 10% across the board, that also raises its set of issues. Would you include trade with Mexico and Canada, which have already done Trump trade deals? The USMCA was a Trump trade deal. Do you include oil imports? We import oil, we export oil. Do you tax the oil imports? Do you include pharmaceutical imports and push up the price of pharmaceuticals? All these are sort of unknown questions that become very, very critical if Trump's in that world of moving forward with tariffs. So I think the details are known, the contradictions are not known, the contradictions are real, but the direction of travel is fairly easy to forecast.
Yeah, thank you. And what that tells me is that we are in for a world with elevated uncertainty, policy uncertainty. So, one of the things about free markets is that there is an element of predictability. So you can look at excess demand, excess supply, figure out which way things are headed. Here, looks like he's going to be tactical. He's going to, change course because if something is not working. One of the things that you also highlighted in some of your pronouncements is, the figuring out. Yeah, we can see you now. So the question of what is the actual value add? How do you measure the content requirements of like domestic content requirements? And this is going to be a challenge for everyone because what we have seen as a result of the Trump tariffs is that they have that the local content requirements. The Chinese share of content has actually not gone down, and so that's something that I guess will add another layer of complexity. But for financial markets, I think this looks very nasty, right? Because you're going to be dealing with a lot of unpredictability.
I think that's a safe forecast. I think the hard question is, some of Trump's policy moves historically have been rather pro-business. And so Trump was pretty good for the stock market the first term. Some people think he will be pretty good for the stock market the second term, that the impact of lower corporate tax rates will overwhelm the impact of a world where the president, at a minimum, comments on the Fed interest rate policy by tweet, and at a maximum tries to set Fed policy, and a world where uncertainty about the most fundamental aspects of post-war trading rules will extend not just to China, but to everyone. I think one thing that has been clear about candidate Trump's views on trade is that he no longer is just focused on China. He's focused on everyone where the U.S. has a bilateral trade deficit, and that's pretty much everyone. So the scope of uncertainty on trade policy seems likely to me to expand to a broader set of countries. I think this is critically important for Europe, for example, because there's a lot of, the Trump administration actually had started a set of trade cases vis-a-vis Europe that they didn't, that the Biden administration more or less dropped. And then the Trump administration, but they were dropped in a way or just not pursued. They weren't resolved, so that legally those trade cases are there and can be activated. President Trump left his administration starting a 232 national security investigation into conventional auto imports. He could pick that up, and that obviously is targeted at Germany and at Japan, and potentially at Korea, which is a free trade agreement partner. But it's not clear that Trump would say, if a free trade agreement is resulting in a lot of Korean imports and not many exports to the U.S., that he'd want to keep the trade agreement. And he obviously is not going to worry about U.S. WTO commitments. And so it does set up a more conflictual trade relationship. And it is also the case, and I think you alluded to this, that a number of countries contemplated taking trade actions of their own against U.S. non-WTO compliant measures in the Inflation Reduction Act. So far, they've mostly held off. The only country that supposedly, is going to challenge the Inflation Reduction Act in the WTO is China. And I think the trade lawyers who I worked with at USTR look forward to that case. Pot calling kettle black. But Europe could go forward with that case. Korea could go forward with that case. So you could have a set of cases with allies in the WTO, which the U.S. would almost certainly lose. So you could imagine a world of much, much, much more trade conflict. Flip side of all this is Trump is actually much less interested in a lot of ways in green industrial policy than the Biden administration. So, the Inflation Reduction Act is a Biden policy. Support for electric vehicles is very much a Biden policy. So one of the irritants, the Buy North America provisions in the Inflation Reduction Act, would likely go away because we get rid of our electric vehicle subsidies. And Trump, at least in his first term, didn't make much progress in developing an industrial policy. He relied more on tariffs. So if it is indeed Trump, and I think it's uncertain at this point, because I think the Democrats, I do believe that some of the noise about Senator Schumer and former Speaker Pelosi putting a bit of encouraging President Biden to step aside and allow a new generation to run I think there's something to that, and we'll see how it plays out, and that might change the election yet again. So it's not a done deal. But President Trump would not necessarily carry over the industrial strategies. And that has not been Republican policy. And a lot of the industrial strategies were built around supporting a green transition that President Trump frankly doesn't believe in. Where he would do is provide a lot of policy support, probably including some subsidies for traditional fossil fuels.
No, super. Let me quickly squeeze in another question on the US, and then I have some on ASEAN and Japan, etc. So the last one on the US is some clarity from you on what a US president can and cannot do, right? Because at least when I work with the government, I can sense that there are checks and balances. So individuals cannot really play around too much. I know the U.S. executive is much more powerful, much more empowered than, say, the Westminster style system that we have in India, where the permanent bureaucracy is a permanent bureaucracy, and the U.S. that's not the case. So legally or constitutionally, what are the things that a U.S. president can or cannot do? Some words on that.
Look, it's not as clearly defined as you might think. The place where President Trump, or both President Trump and President Biden, have the most space is to change the terms of trade vis-a-vis China. Why? Because the Section 301 case that is the basis of most of the tariffs is live, it is active, it has not been challenged in the courts. And in theory, the Section 301 case was mitigated by the so-called Phase 1 trade deal at the end of the Trump administration, which China signed up to. And then China was supposed to buy an enormous amount of American goods, if you remember, and it hasn't. So there's a legal basis for doing more tariffs against China simply because it hasn't lived up to its commitments under the Phase 1 deal. And the envisioned enforcement mechanism in Phase 1 was an extension of the tariffs. So there's a straightforward legal mechanism that does not require any congressional authority. It is on the books, it's ready to go. You probably have to do some notice and comment about the new tariffs, so it can't happen necessarily on day one, but there is no legal or congressional obstacle. The same is true with some of the trade disputes that were set aside with the Europeans. There are Section 301, same legal basis, cases against European digital services taxes. They provide on the books authority to put tariffs on certain European goods. So there are certain things that you can just pick up from where the Trump administration left off. Things that take more time are new 232 investigations, the national security investigations. But just as there was the national security tariffs against steel, you could, if you wanted to, using existing congressional authority, so without new acts of Congress, put in place tariffs of, a size to be determined. The steel tariffs were 25% on a broader set of sectors. The constraint is that in 232, it needs to be tied to a sector, and you need to argue that sector's national security important. That's probably a constraint, not that much of a constraint. Then you have some other authority. There's an authority to do across-the-board tariffs on a temporary basis for balance of pay in a balance of payments emergency. The same authority that was used by President Nixon in the Nixon shock in the 1970s. That is still on the books. The difficulty with that, if you want to do a 10% across the board tariff, is that authority explicitly only allows temporary tariffs, 60, 90 days. So it's not perfect. The other authority that some people have argued are some of the international economic emergency powers, IEPA, which allows, again, under national security justification, a lot of transactions, pretty much any foreign transaction, to be blocked. blocked. There's a debate about whether a statute that is designed to block transactions can be modified to tax transactions. But let's say you say everything is blocked, but if you put aside 10% in escrow at the U.S. Treasury, it's freed. Well, that kind of looks like a tax, but it's done within the structure of that statute. So I think there is substantial executive authority on the trade front. The main constraints are that any changes in tax law or spending, in theory, have to go through Congress. The debate on IEEPA is whether this is a tariff and whether a tariff is a revenue measure that needs to originate in Congress. I wouldn't underestimate what a determined president can do using the delegated authority under the existing trade statutes with a lawyer as creative as Bob Lighthizer.
Okay, so that's that. I mean, clearly there is a lot that can happen. So I think the checks and balances will take a while to play out. So thank you for that. So I'll now start blending in some questions from the audience as well. You see, a very integral part of industrial policy, because it is about domestic policy promotion as much as it is about trying to sort of stall China's progress, because the larger it becomes, it is more of a defense threat to other larger powers. So starting with Japan, I mean, you very clearly stated, and I kind of agree with you, that the JPY is like massively undervalued. You don't have to, go far. You just visit. I mean, I noticed that haircuts in Japan are now comparable to haircuts in Mumbai. Maybe I go to a more expensive barber, but I don't think it is the most expensive barber here. So clearly, I think JPY is undervalued. How long before it kind of starts to correct? Because clearly, if the US president wants a weaker currency and the Japanese want a stronger currency, they're clearly fighting against the devaluation. They think it's a national embarrassment. There will be some. So can there be a reverse Plaza Accord, for example?
Look, the easiest way to see a reverse Plaza Accord is actually with China, because China does manage its currency. And so if a new Trump administration were to be willing to not go forward with big tariffs on China in exchange for a stronger yuan, that is a deal that could be carried out. Strengthening the yen is an interesting one. I mean, you could imagine two different views. One view is like, sure, we want Japan wants a stronger yen. Japan has been intervening at the margins to support the yen. The US wants a weaker dollar, which means a stronger yen. So why couldn't the US and Japan agree to joint intervention as opposed to just the current status of unilateral intervention to get the yen into a slightly more balanced position? You'd have to agree to do the intervention jointly. You'd have to agree when it goes too far, so forth and so on. But with Japan, I think it is within the realm of possible. It is almost impossible to see how you do that with Europe, just because the ECB doesn't have a mandate that extends to currency management, and any deal that involves trade-offs across other issue areas touches on the competence of the Commission. So it goes outside the scope of the ECB's remit and mandate. The other difficulty is that the difficulty you mentioned from the very, very start about policy coherence. If Trump is pursuing an expansionary fiscal policy, and Jay Powell concludes, and Jay Powell is still the Fed chair, that this is threatening the achievement of the Fed's inflation objectives, the Fed may be on hold rather than cutting. And if the Fed is on hold, you can still see why the yen might depreciate, partially just because it is so weak, and partially because the Bank of Japan may be looking to may feel comfortable raising interest rates. So even if the U.S. is on hold, the Bank of Japan is raising rates, and that strengthens the yen a bit. But you could also imagine scenarios where the Fed is not on hold, but it feels like it has to start hiking again. And that would typically be pretty negative for the yen. And you can imagine scenarios where Japan sees a 10% across the board tariff or a tariff on a 232 tariff on auto imports. And it says, well, we need to offset the impact of US tariffs with a weak yen. We're going to stop trying to support the yen. So I think you can imagine a lot of different scenarios, some of which would get in the way of what I assume is a set of pressures that will eventually bring the yen back to more reasonable levels. I mean, I think the Ministry of Finance has actually done a pretty good job intervening on the back of U.S. Soft data to bring the yen from 160 and change to around 156. I think there's motion underway to reconsider the hedging strategy in foreign assets of the government pension investment fund. The Wall Street Journal reported on that. It's a 800. It's more like a 1.5 trillion fund, but half their assets are abroad, and those are all unhedged. You could start hedging some fraction of that, and that will meaningfully change financial flows. And if Japan wanted to get serious, they could tighten regulations on the life insurance sector and reduce the amount of open positions, bets on further yen weakness in that sector. So I personally think Japan has a lot of tools. I personally think the interest rate differential is poised to shrink from admittedly very big levels. I think there's already been a convergence, a reduction in the spread between 10-year JGBs and 10-year treasuries. I think the complexity that comes with Trump is these sets of pressures you can imagine a deal, as with always with Trump, that pushes the yen up much more quickly. But you can also imagine some uncertainties and some trade push that leads Japan to conclude that it needs a weak yen. So you could see some measures that make what otherwise would be a normalization much more difficult. So I think it's hard to forecast, but I do find it an extremely interesting currency pair, as you know.
Yeah, no, I know. And so this was a question from Mandar Kulkarni at KPIT, and I think his question, which I think you answered, was that is it linked to domestic inflation or domestic economic strength? But as you rightly mentioned, there is a lot of policy intervention that is at play. It need not necessarily be dependent on how fast the Japanese economy grows over the next 6 months.
The easy way of answering that question is that if you look at the difference between U.S. policy rates and Japanese policy rates, the difference in policy rates is actually currently bigger than the difference in inflation rates. So it is impacted by inflation. And the relatively weaker pace of inflation in Japan over time is one reason why the real effective yen is so weak. But it is policy in relation to inflation. Japan is still running an expansionary policy. The U.S. is running a restrictive policy. So the policy delta is bigger than the delta in inflation.
And so going a bit south, so clearly I think the Koreans who at one point thought investing in China was in their interest, and now with the TFT LCD industry in Korea getting wiped out, the battery chemical companies starting to suffer. I think they're starting to have second thoughts. And what we've also noticed is that this record increase in the trade deficit or the trade surplus that China reported, year on year, the biggest impact was on ASEAN. So Thailand, Malaysia, Indonesia. Now, some of it, as you also observed, could be just that the exports from China are moving through ASEAN to US and Europe. So it could just be a shifting, and in turn, some of these economies could be having a bigger surplus with the US and Europe. But it does seem like from news flow that factories in Thailand are shutting down, factories in Indonesia are getting affected. Is this a repeat of what we saw in the mid to late 90s, where there was, like in 94, a 33% yuan devaluation, and then 96, we also had massive Chinese overcapacities. I remember reading There were like 1.3 billion shirts in warehouses. There were 16 million TVs, and they started dumping it into ASEAN, and that kind of worsened the Asian financial crisis. Is there a risk that the ASEAN starts to rethink RCEP and starts to worry about what Chinese overcapacity can do?
I think you would probably be in a better position to answer that question than I am. I think the analytical basis of that is figuring out what the balance is between Chinese exports to ASEAN that are supporting ASEAN exports to the rest of the world and Chinese exports to ASEAN that are displacing domestic production. I do think that every country in the world with a domestic auto industry has to figure out what its policy is going to be, partially because of the pace at which China is scaling up its electric vehicle production capacity, but also because China, and that includes the joint ventures, the Hyundai's JVs, the GM JVs, the Toyota JVs, all the JVs, the internal combustion engine side of China has a capacity to make, say, minimum 30, maximum 40 million cars a year, and domestic Chinese demand for traditional cars is 15, less than 15 now, 14, and falling really fast. So there's just any small economy could fully meet its auto demand with cars from China. It is within the realm of possible. And so if your trade agreements don't allow you to introduce enough protection, you may reconsider your trade agreements. I mean, I think, or you may look for measures that are consistent with your trade agreements that slow down the effect, like the Europeans do. The other consideration, I assume, for a lot of Southeast Asia is that they have to make their own judgment about what President Trump is likely to do. So I'm sure all of the Southeast Asia diplomats in DC are working very, very hard to figure out if Trump is going to do a 60% tariff on China, but not go forward with a 10% tariff, which broadly speaking should be good for ASEAN. It makes ASEAN even more attractive as an export base, or whether President Trump's going to do the 10% tariff, which hits ASEAN, and then you might have to, in order to get out of the 10% tariff, you might have to get out of RCEP, you might have to agree to Chinese content limitations. So I think it really, really is open and depends. But where I do have a lot of confidence is that in sectors like autos that are important, that generate a lot of jobs, and where China clearly has plenty of capacity, can meet any, China has enough spare capacity to meet U.S. auto demand, and the U.S. is the world's second largest auto market. Any country has to figure out how it manages that pressure. And I did agree with you, I very much agree that the press reports about Thailand are important, significant, and is something well worth watching. You all in India are pretty good at protecting your own sector, so you seem to have decided. But I think some other countries have been a little bit more open, and they are dealing.
We've had a history of dealing with China, so and there are the Himalayas which kind of protect us, but I think trade is much harder to do. But that brings me to the question, and there are two questions. I will combine them. So one is from Nitin Parikh of Hindalco, and the second is from Rasik Shah of Reliance. See, if India has, because India is still maybe 15, 20 years behind where China is in terms of per capita incomes, and we still have to create jobs, we still have to grow, we still have to reach at least upper middle income status, if not rich country status. So what can be the approach, and this is slightly more prescriptive, that India can take to be part of GVCs in this kind of a world? And given the incredible amount of balance sheet, and this is like wars happening. I mean, India doesn't have the balance sheet to intervene at this scale. What can be the strategies, and how should India play it, or how do you think India comes out of this?
Look, I think there's a bunch of concrete and practical questions One observation is that, and I think it's an open question because the Trump administration first term didn't answer it, is to what extent our global value chain is going to kind of disappear. And what do I mean by that? Plugging into global value chains used to mean importing components from China, semiconductors from Taiwan, liberalizing some import restrictions so that you can bring in imported components, do final assembly and export. We may be in a world where the US no longer trusts Chinese components. And so the traditional global value chain becomes a fragmented global value chain, and you need to have, or a secure global value chain, and you need to have components that come from countries where that the U.S. feels comfortable with if you want to sell to the U.S. That may mean using some of the semiconductors that emerge out of the CHIPS Act, as opposed to using Taiwanese semiconductors. There may be restrictions. So we may be in a different world, but still a world that creates opportunities for a trusted ally or, if not ally, a partner that can provide assembly, lower end appliances, things where, production in the US at relatively high US wages, or even in Mexico, doesn't make a lot of sense. And so there will be opportunities, but they won't be the classic opportunities of plugging into what has been a single unified global value chain. There's also a possibility, which is more or less how the first Trump term played out, that the opportunities to plug into global value chains are greater than ever, because the only thing you have to do to get around a prohibitive tariff on Chinese goods is to do a little bit of assembly outside of China. You can use Chinese components, no problem. In which case, I think India has an easy, all countries that want to plug into an existing network have that opportunity more easily. My gut is we're going to be in a world where you're going to start seeing more than we have seen rival networks, rival value chains, and being part of one may give you an advantage over countries that are part of both or part of the Chinese value chain. But that's just a guess. I think also, I'm not at all an expert on India, but I think India has opportunities simply from its own, the investment needed to build up India's own infrastructure, its own movement towards the production of more advanced goods, nuclear power plus electric vehicles using a battery supply chain that doesn't come from China would be a solution to the pollution problems that are very real, as I understand it, in India. And so that all could be a sort of made in India supply chain. And the development strategies that get countries to middle income may no longer be plugging into this assembly as the first step to building components strategy that worked for Southeast Asia and worked for China. So I think it's much less clear right now, to be honest.
Yeah, and just to put some context behind this, India is about to sort of finalize the FTA with the UK. Someone would say we should have done this a while back, but either way, there's some visible progress. Progress with the European FTA is also, I think, it's pretty decent. So once those start working, maybe then there will be end markets that India can rely on as well. One and quick final one. I know we are coming to the end of the hour that we had booked with you, and if you have time, maybe we can take a few more questions. But one that I do want to ask is the role of the RMB. I know, you've done some fascinating work on actually tracking the flows. Not theoretical work, but looking at the details of not just what appears in the balance of payment statements, but actually digging beneath those. So how big is the risk? We observed that imports from, into China from San Marino and Bermuda are like at ridiculous levels. It's a $7.5 billion economy, and there's importing some $60 billion a year. So clearly there is capital flight happening from China. There are these rumors on these inconvenient truths. I don't know if you follow that Twitter handle about China, which seems to say that 30-year-old tax cases are being opened up, so the rich would be trying. So there is this trade surplus because there's a weak domestic demand, there is import substitution, there is clearly a growing share of manufacturing, and they've stalled, I think, Chinese tourists from going out to a large extent. But at the same time, there is a lot of capital flight happening, and foreign capital, I think, is reluctant to flow in. So do you think there are any balance of payment stresses that may emerge in the next 2 to 3 years, which can put the RMB at risk? Currently, from what you've said, it is, if they do it, it'll be more tactical and deliberate. But is there a risk that the RMB starts to come under stress because of fundamental reasons?
I think there is, but I don't think the fundamentals will come from the balance of payments side. I think right now, I agree with your broad observation that you have a big influx of foreign currency from the goods trade side that allows for what for other economies might be a high level of capital outflows. But for China, given the size of the goods inflow, it's still a manageable level of capital outflows. I look very closely at measures of pressure. There's a little bit of evidence of pressure in one indicator, foreign currency settlement, but the other indicators don't suggest that the state banks are selling that much yet. They're selling a little, but they're not selling as much foreign currency as they bought in 2020 and 2021. And the PBOC, again, it's a strange, obscure, hard to read, could be hiding something structure. But the PBOC really hasn't sold any foreign currency if you look at its reported balance sheet. So right now we're at an equilibrium, in my view, where if there isn't a shock, you cover the pretty high level of outflows, the desire of Chinese residents to build up safe assets abroad out of the trade surplus. I think there are two potential sources of shock or stress. The one shock that could come from within China is that China's own economy continues to be quite weak. And in the face of ongoing weakness, China might conclude that it wants, and this would be a bold decision, one that risks a reaction from the United States and others. It might just decide, hey, we would prefer an even weaker yuan. And so we will choose to allow the market to take the yuan down. The weak point in the yuan over the past 10 years has been about 7.3, 7.34. We're not very far from it. And if China just let the yuan go through that old level of support, it becomes a betting game, and a lot of people will bet that it'll keep moving until you get to 7.5, 7.6, 7.7, 7.8, even 8. And so that would be a meaningful shock, one which I think would pull the many other countries in Asia down. You have a really weak yen, you would have a really weak yuan. It'd be very difficult if you're Thailand to have a strong baht, or if you're Malaysia to have a strong ringgit. And I do put some risk on that. So far, China's sort of said we want stability. They seem comfortable letting the fix, the midpoint of the band, drift towards 718. But if you go take the midpoint below 718, you're actually pushing the edge of the band beyond 7.3, 7.34, and you're sending an additional signal. So I think there's a possibility that China, as a matter of policy, basically tries to devalue and export its way out of the real estate slump. The IMF has been ambivalent on this. If you read the last IMF Article 4, they said they wanted that China should move towards more price-based monetary policy transmission, i.e. cut rates, and should move towards more exchange rate flexibility, which would mean a weaker yuan. And many countries, in the face of big real estate slumps that they can't solve on their own, Thailand in 1997 being the most famous case, solved their economic problems from a real estate slump by exporting their way out. So I think that is a very real, very significant risk. It's one that worries me, frankly. And I think it's also one that assures that within the realm of trade conflict, you get much more trade conflict independent of the outcome of the US election. The other shock is a Trump shock, the one everyone likes to talk about, where Trump puts on those 60% tariffs or threatens them on day one. Looks like they're going to happen. And China says, you know what? CNY is going to fall to 8. Where we have to offset all the negative impact on our trade with the US by exporting more to everyone else. We were doing you guys a favor by supporting our currency. We're not doing it anymore. You know, that's within the realm of possible, and that has reverberation effects. So, you know, between the variance there is pretty big. You could have China respond to very big tariffs with a very big devaluation.
Yep.
Or you could imagine, which is the idea that Lighthizer sort of seeded, maybe the U.S. would strike a deal with China where China goes back up to 6.5, a revaluation, an appreciation, and the tariffs stay mostly where they are with some adjustments. You know, I would be looking really closely to see where, if Trump does actually win, which direction he would want to go. And I would also think that if there is a second Biden term, I think a second Biden term, given look at some of the things that Undersecretary of Treasury Jay Shambaugh has said about overcapacity. I don't think there's much tolerance on the U.S. side for a Chinese policy mix that seems to export its way out when China clearly hasn't taken steps to support internal household demand. So I think that you might see more hawkish, Trumpy policy even out of a second Biden administration if China chooses the export path.
Yeah, so that speech actually is quite fascinating. I mean, I didn't realize it was that important. I'm going to take those views from Jay much more seriously now. So thank you. I think we are well past the hour. We are almost at 70 minutes since we started, and the audience has been online for a while as well. So I think there are more questions, like, you know, on whether the Cold War becomes a hot war. And frankly, I mean, it is actually.
We all should pray that it does not.
Absolutely. And I don't think it's in anyone's interest. In fact, finally, you know, what the Chinese regime also wants is stability, and hot wars can become quite unstable and can be destabilizing. So thank you, Brad. I mean, I think this has been a fascinating discussion. Definitely, as you may have heard, I was taking notes. This is quite a bit of useful stuff. I appreciate the candor and patience with which you answered our questions. Thank you, everyone in the audience, for being patient. We had some technical glitches, but I hope the lovely conversation we had with Brad made up for it. So with that, I think we can close the session. Is there some closing remarks that we need to make?
Yes. Thank you very much. And Axis Bank, this concludes the discussion. I could take a moment to convey gratitude to all our speakers for their time and benefit of their experiences. We look forward to the next edition of our Treasury Market Talks. A recording will be available in case you wish to have this passed on to your colleagues, and relationship managers will be able to help with this for you. Once again, thank you for joining us. You may now log out. Thank you.